Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Eric Schleien. Thanks for being on the show, Eric.
Yeah, it's my pleasure. How are you?
I am excellent. Great to have you on the show. I think you have some experience. I think it's going to help us to better understand a different part of our real estate business, or a different kind of real estate out there that a lot of us are not going to be as familiar with. So looking forward to the conversation. But Eric is the founder and CEO of Granite State Capital Management and is a host of the Intelligent Investing podcast. He is a value investor investing in private and public real estate. Eric, welcome to the show. Give us a little bit about your focus right now, who you are, and let's talk about this, publicly traded real estate. What is that?
Sure. Well, a little bit of background about me. I got into investing when I was a teenager, about 14, 15 years old, and went into a bookstore with my mom and wanted to be mature and a big boy and go to the most mature section I could find. So I went to the business section and I found a book by the Motley Fool. It was a book on how to make more money than your parents was the something of the title. I thought that was very intriguing. It talked about, very basic financial concepts, the dangers of being in credit card debt, don't spend more than you earn. And then I saw that compound interest graph that blew me away. And they talked about different great investors in the book. And one of them was Warren Buffett. So after researching some of these investors, I started reading about Buffett, and for me, that was like a light bulb moment for me. And I went down this investment rabbit hole using those value investing principles. And I realized they could be applied to pretty much any kind of asset, including real estate. So I think, when people think about value investing, they just think, oh, you're just buying, stocks at, low PE ratios or something like that. But really you could be, looking at different kinds of public securities, different kinds of bonds, different kinds of, private real estate, and there's also publicly traded real estate. So there's a whole host of assets you can, get a good value on, but those principles have sort of been a guiding light for me. I'm 33 now, so for quite a while now, and I started an investment management company. I also have another real estate company as well, which doesn't have outside investors. But yeah, I'm happy to be here and talk to you about real estate that you could buy that's publicly traded.
Tell me, can you just lay that out a little bit so we can
Sure.
understand what you mean when you say publicly traded real estate? What is that, and how do what does that mean for those people that are involved in that?
Sure. So there's two ways you can invest in publicly traded real estate. So what I mean is, if you have a publicly traded asset, it means that it's on a market. You can go into a brokerage firm such as, TD Ameritrade. I use Interactive Brokers. And you could buy, you type in a stock symbol, and what you're buying, the assets represent real estate ownership. So, when you're buying any kind of stock, right, it's not just a ticker symbol moving up and down on a graph. Those are representing some kind of assets and liabilities, and you have real cash flows on the balance sheet. So it's legal ownership in equity. When it comes to real estate, right, there's things like, say, real estate investment trusts, which literally you're buying actual ownership in a piece of real estate. There's also, though, companies, say, where they own a lot of real estate on the books. So, say a company that's structured as a corporation or structured as a limited partnership, but a lot of their book value is in real estate operations. Well, if you buy a stake in that company, whether it's 10% of the entire business or 1/10 of 1/10 of 1/10 of 1%, you still are taking ownership in a piece of real estate. So that's what I mean by publicly traded real estate, is going into the public markets to take a fractional ownership stake in real estate assets.
When doing it through a publicly traded firm like that, are you getting tax benefits? Are you getting other benefits as just like you would if you were investing through a syndicator or operator?
Well, so since you are owning a stake in the business, the tax benefits that you're quote unquote getting, and again, it depends on the structure, right? So if you are investing in a limited partnership and you're getting a K1, there could be some tax benefits to you. But if it's not a limited partnership, the tax benefits are happening at the corporate level, which is reflecting in, the value of your shares. So the tax benefits still exist. It's just that you're not usually going to see them show up on your personal tax forms. It's going to show up in the increased value of the share price if the management is a good steward of your capital.
No, that makes sense, and that's kind of what I expected. Just wanted to ensure. So why would someone invest in a publicly traded type of real estate versus a syndication or a one-off operator?
Yeah, so that's a good question. So one of the things that I learned from studying in Warren Buffett and his partner Charlie Munger over the years is neither of them have any kind of psychological attachment to the kind of asset they invest in. Right. So, look at Berkshire Hathaway, they're a conglomerate, they bought they bought a 100% stake in Dairy Queen, and they had bought, a piece of the Washington Post and Coca-Cola, and they own a stake in Apple now. So they aren't just tied to the insurance business. And you could even say going back to the 1960s, if they had just reinvested in the textile industry, they wouldn't be a company today. So a lot of people have sort of this psychological anchoring that, if they run a business, they must, if I run a shoe company, I must just grow by making more acquisitions in shoe businesses. And I think you see the same thing in real estate, right? You have people say, well, I only invest in single family, I only invest in multifamily, I just focus on, mobile home parks. And I'm not saying there's anything wrong in doing that. Certainly if you feel you have an edge or a certain kind of market very well, you should certainly stick to where you feel you have some kind of edge, whether it's informational or just that the market really well. However, if you aren't attached to the kind of asset that you're buying, there's a whole world that opens up. So the reason to look at public real estate is to make money. And we happen to live in a time right now where, interest rates are very low. Cap rates on lots of private real estate deals are, depending on the market, but generally pretty low. And there are some exceptions in some cities, but for the most part, pretty low. And in the stock market, I would say actually generally stocks are on the expensive side, that most of the stuff that I look at. However, if you can own something that isn't GameStop or isn't some kind of high flyer, aka a business that owns a lot of real estate, some of these companies are kind of hard to categorize. And the thing on Wall Street is that if something isn't clear cut, black and white, this is the industry it's in, and we can package it in this mutual fund, often it gets left behind, and that creates an opportunity, for investors like you and I who aren't running gigantic mutual funds. For full disclosure, I'm running an investment management firm and I do have clients. But even the firm that I run is pretty small, and being a small investor, there's opportunities to buy publicly traded real estate that would be, 50, 75 cents on the dollar of, or less sometimes, of what you would get in a private transaction. And it hasn't always been this way. So, if you go back like 20, 30 years, you could say that publicly traded real estate was actually tended to be more expensive. But you have the inverse situation today where there's, I think, more opportunity in these publicly traded real estate assets that some of them are significantly, trading at significant discounts to the actual private market value of that real estate.
Tell me about, that who is that investor that's like the prime candidate for investing in publicly traded real estate? Is that just anyone? Is that, who is that investor?
So I would say it's someone who has, they're not looking to get rich quick. They have a, long-term time frame, and they're in it for the long run. So, we talked about tax benefits, right? If you can own an asset and not sell the stock for 30 years, you're essentially deferring capital gains for decades. So If you're looking to do short-term trading, or you're someone who's like flipping homes, and this is probably not for you, but for someone who has a long runway ahead of them, or they want to pass stock on to their kids at some point, investing in some publicly traded real estate with good management, there could be an opportunity there.
For sure. What about, I was just thinking through, like, investing through publicly traded real estate, in that individual. What about just, how do they know? Think about somebody that's never thought about investing in real estate, through publicly traded methods. What do they need? What are a few things that are very important that they know? How do they know that they're making the wise decision as far as how they invest this way?
Well, so first to start off, I'm not going to be giving investment advice. So, anything I say, do your own due diligence.
Sure.
But look, it's the same thing with real estate, right? If you're getting into real estate, I would hope that you have some understanding of the asset that you're buying. You're not just, that's a nice looking house, I guess I'll just spend whatever on it. You wouldn't do that. So it's the same thing with a stock. If just because you think the business is interesting or good, doesn't mean that the price is good. So you want to be able to learn how to figure out what those assets are worth. So I would say if you're already someone who's a real estate investor, you can use the same principles that you're going to analyze a piece of real estate in a private transaction. If I'm looking at a privately held self-storage unit, there's a certain value I'm going to put towards those cash flows. Well, I can do the same thing with a publicly traded self-storage company. It's the principles aren't going to be any different. I would say if you don't really know how to value a business or how to value real estate, then I wouldn't recommend that you go ahead and start investing in real estate, or find someone who has a good track record and has a rational and intelligent way of looking at things, and go put your money with them.
Is this kind of investment a liquid, and are there minimums?
So depends on the stock. There's one stock in particular that I'm thinking about that I have a pretty large position in at my company that's pretty illiquid, but at the same time, it's going to be more liquid than, buying a single family home somewhere, which, as that could be on the market for a while before it sells, depending on the market. So, there's one stock in particular I'm thinking of where, it might take me, a few weeks to sell my position, but, that's a liquid for a publicly traded stock, right? If you buy and sell Coca-Cola, you could put $1 million in and sell $1 million within a matter of seconds. But again, if you're a long-term investor, having this instant liquidity shouldn't really be an issue for you.
Yeah, that's a good point. Do you have an example? Maybe you could just kind of walk through an example of somebody of a investor that actually did this, and the types of maybe returns or their expectations and things like that.
Well, I'll use myself as an example, since I've done this a few times in my life. So there's one of the stocks that I own at my company, and I also own this for most of my investors. It's a business called LACO. Stands for the Los Angeles Athletic Club. The ticker is LAACZ. And right now, I think it's a publicly traded limited partnership. It's run by the Hathaway family, and they've been a staple. That family has been a staple in Los Angeles for about 100 years. The company is from the 1880s. They started with the Los Angeles Athletic Club, and for any of you, your listeners that live in LA, they certainly know what the LA Athletic Club is. And so they to grow the business, they had sold some shares to investors. It became traded over the counter for about 100 years now. And then a few decades ago, the company started reinvesting those cash flows into self-storage units. So today, while they still own the athletic club building, which is certainly worth something, most of the business is in self-storage units today. Now, if you look at the brand, the self-storage company that they own is called Storage West. That's the name of the self-storage business. And most of the business is in either, California or Arizona or Texas. It's all on the West Coast. Very high quality self-storage business in very, very good locations. And, generally you could say that those self-storage units would probably get somewhere between, maybe 4 or 5% cap. Well, today you can buy the entire business of Laco. You would buy stock in it or units because it's a partnership for probably, an 8-9% cap rate today. So you can go on the stock market right now and trades for about $2,400-$2,500 a unit, where if they decided tomorrow they wanted to sell the self-storage business, they'd probably get at least $4,000 a unit for those self-storage operations. So here you have a situation where, you're getting slightly under a 4% distribution every year in dividends. And you have this tremendous asset value that at some point they might sell the self-storage business and you would get an extra boost. So if you take in distribution yield plus growth, you're looking at, maybe 8 to 10, 8 to 11% growth in a very conservative scenario. And then if, say they sell the self-storage business in 10 years from now, and you take into account rent increases, you might be getting a 15% annualized return over the next decade. So I don't know exactly what the returns are, right? You can never promise an annualized return, especially with a publicly traded stock. But there, to be able to have something with probably pretty low downside, again, probably do your own due diligence, but my opinion is that there's pretty low downside and you're getting the stability of a bond-like asset with significant optionality to the upside if they end up selling out of those self-storage units in the next decade. So that would be an example of a public real estate where if I was to go out right now with a broker and try to buy those exact same self-storage units, from Storage West directly, I'd be paying a price significantly higher than if I just bought Laco units outright on the stock market.
Okay, no, that's helpful. Bedford's Cost Segregation specializes in generating significant tax savings via their engineering-based studies for commercial real estate clients nationwide. Founded in 2002, Bedford is one of the largest independently owned cost segregation providers in the country, with over 14,000 studies completed to date in multiple offices throughout. The most important decision ownership can make when incorporating cost segregation within their real estate portfolio is selecting the right provider. With only 43 certified cost segregation professionals nationwide, Bedford is proud to employ 8 of them and takes the quality of their people as seriously as their studies. Every certified cost segregation professional has passed a rigorous test combining knowledge of technical engineering issues, legal tax issues, ethics standards, and requires a strict level of prior work experience to be eligible. Bottom line, not all cost segregation providers are created equal. So be sure to take the decision seriously from the beginning to protect yourself for years to come. Please contact Bedford's Business Development Director, Frank Judici, to learn more. And I wonder, when you're making that decision to, invest in them, how much of that business plan do you know up front? Like you talked about, if they sell this many years, from now, this might happen. Do you know any of that going?
No, I actually take into the assumption that it doesn't happen, right? So one of, as Buffett would say, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And, there's another guy in the investment business who very much respected and admired, named Monish Pabrai. He wrote a book called The Domdo Investor, which he talks about this concept of a low risk, high uncertainty. So is it certain? Is it certain they're going to sell the self-storage units the next 10 years? Not at all. There's high uncertainty. However, I would say you're buying it at such a discount to the real estate that there's a bunch of different situations that can happen, but there's very few ways to lose and many, many ways to win. So I'm actually always looking for, in a bad scenario, am I still going to do okay? And I think in a bad scenario, you're still doing, high single digits to low double digits in a sort of, if things just keep going the way they are. And I mean, the family has been managing this thing for, the self-storage business for decades. I can tell you what they're not going to do. I can tell you they're not going to start taking out more leverage and, leverage the self-storage business, super high. It's like they're overly conservative. If you or I were managing that business, we could actually juice up returns. The family is already wealthy. They're not, they're looking to stay wealthy, not get, I'm sure they're looking to get wealthier, but they could take more risk if they wanted to. So they're probably actually hurting the value a little bit by being too conservative and not having enough debt, especially in a low interest rate environment. So if they ever sold to a larger public, say like Public Storage, or they sold to a REIT or something like that, certainly that business would take on more debt. The things that I do know, though, is that the Hathaway family controls 70% of that stock, and that they're using it for, they're using their dividends. A lot of the family members are using the dividends for, their mortgage payments and to feed their families. So that's the reason for that conservatism, is they want to stay around for very, unknowable black swan kind of events. So very well capitalized business. They're not going away. But you should kind of, I see it as a very high yielding bond that has significant upside if a few things happen.
Yes, and I ask every operator this, and I'll ask you as well. But thinking about it towards publicly traded real estate, and you've talked about it a lot, but always ask how you prepare for a downturn, right? And is there, with your experience in this industry, what have you seen in companies like this versus others, and how they were prepared or how they performed through this pandemic over the last year, and just what you like to see that says that we haven't already mentioned. I know you've talked about it a lot, which is great, but anything that's specific to say they're ready for that black swan event.
Yeah, well, Lego in particular is especially ready. I mean, they're even though they're public, they're still run like a family business. They are traded over the counter, very thinly traded. So for all intents and purposes, they look at themselves pretty much as a private business. There's only about 100 and something, shareholders of record. I went to visit the property, the athletic club a few weeks ago, and I asked the assistant manager. I said, how often do investors come by? And he said, you're the first person in like 5 years. So, they're looking at to manage it for the family, but they're over the top conservative. But in general, what I'm looking for in a management team is, a very well capitalized business, one that isn't spending money on pet projects. So you do have some, say, real estate investment trusts. I'm not gonna bash any management teams publicly, but what I will say is you want to avoid companies that have a history of just selling lots of stock and investing in these pet projects, or investing just to expand their empire. So, anyone can just, as from investing in real estate, I mean, you could buy 200 single family homes. It doesn't mean you're getting a good price for it. However, if you're a public business, right? Let's say if you were running a real estate investment trust and your salary was being tied to, say, FFO or some kind of real estate cash flows, you may your incentive to have good returns on capital may be outweighed by your incentive just to grow the business at any cost. So if you can go from a small real estate investment trust to a multi-billion-dollar real estate investment trust, well, then you can bump up your own personal salary. Good for you, not necessarily very good for your shareholders. So you want to look to avoid businesses where they don't know how to allocate capital very well, or they're going to take excessive risk and be highly leveraged. So in a downturn, that you can get wiped out. You want to typically avoid those kinds of situations.
Eric, what's your predictions? Just in the real estate market over the next 6 to 12 months.
I don't know. I try not to spend any brain power on things that I can't control or have an understanding. So I'm taking the position that I'm buying assets that I like today, that I think in a look, if there's a few companies I'm thinking about where in a downturn, if you're well capitalized, you can take those cash flows and buy cheaper real estate. Or those businesses can, with good management teams, they can allocate capital at even higher rates of return. So in a downturn, any of the businesses that are my portfolio or in the portfolio of my investors, they'll end up being better off because of it. And if there isn't a downturn, they'll stay prudent and may even slightly underperform, say some of the highly levered names that are taking excessive risk and, reaching for yield, which, I see a lot of that activity, especially with low interest rates.
Do you have any daily habits that you are disciplined about that have helped you achieve success?
Yeah. So I'm extremely focused on reading. So every day, religiously, I will, read every news article that I can find about the different businesses that I own. I read things about competitors. So, I'm always say for self-storage stuff, I'm always reading about the different self-storage companies. There's another real estate asset management company that I own stock in. So I'm always reading about that company, that industry, listening to conference calls. I also talk to a lot of my colleagues. So there's a few websites that I go on every day. One is called The Corner of Berkshire and Fairfax. And we talk a lot about these kinds of businesses. So if you're someone who wants to be part of a community where, we can talk about things like Lakeco and St. Joe Corporation and Brickfield Asset Management, and, a few other of these kinds of businesses, J.G. Boswell's and kind of a cult stock amongst us. If you join that message board, Corner of Berkshire and Fairfax, you'll be able to participate in a conversation with a lot of very highly intelligent and very open and welcoming people to participate in those conversations. I also read, so I don't usually participate, but I'm always reading that message board. I also, every single day, I open up a Value Investors Club, and there's always a few new write-ups every day. You do have to be a member to read those instantly, but for non-members, you can register for I believe it's either a 60 or a 90-day delayed account, which is free. And most of these, names don't move all the time. So, typically a 90-day old idea, often they're still just as valid. So I read that every day. And then that usually leads to rabbit hole. So I always spend my most of my morning and afternoons just reading.
What's your best source for meeting new investors right now?
For meeting new investors?
Mm-hmm.
That's a good question. When people always, I get asked this sometimes about, what's your process for finding new investors? And, it's just spending time with really smart and interesting people. I know this sounds like a cheesy thing, but I don't have a pitch book. I don't, go out and start aggressively marketing what I do. I'm looking to attract a certain kind of investor, and this is for me personally. So, I like to have people that are going to be with me for the long term. They're not going to give me money because they just are on some emotional high, because those people will leave when they're on emotional low. So spending time with, people who are smart, rational, have a high ethical bar in business. And, people will ask me, well, what are you up to? And, how's your, people know that I do this. So they'll ask me on occasion what I'm doing, what I'm up to, and I'll share. And just through the sort of, natural conversation, kind of like we're even doing on this podcast, there'll be a certain percentage of people, and it's a small percentage, but it's a certain percentage. I'll say, oh, that actually might be something I'm interested in. Maybe I can give you some money at some point. So, that's how I've structured my firm. I have a very boutique firm. I have about 20 or so investors. But all the people that are investors with me, they're my partners, and they're people that I respect and I admire, and that they're not calling me every week asking me how their portfolio is done, and I don't have to suck up to them and play golf with them. So, that's how I do it. But, how I do it may not always be appropriate for, how someone else wants to do it, where they want to have, a sales book and make 100 calls a day. So I would say, if I could give any advice, it's think about the kind of person that you want for investment capital. If you're any kind of investor, because if you don't have good clients or good investors or good partners, I couldn't invest in Lakeco if I had a partner or I had an investor, demanding that I show good quarterly numbers every quarter. That Lakeco would not be the one to buy.
Now, Eric, that makes complete sense. I just appreciate elaborating on maybe that your philosophy on finding investors, right? And just, thinking about who that person is. It's important, that we do think about our avatar, what some people call it, but, of who this investor is that works with you.
Totally.
But, how do you like to give back?
How do I like to, I love teaching. So, I have my own podcast, which I know you shared about on the show, and I just go into the weeds and I share my knowledge. I get messages all the time on Twitter and Instagram, especially Instagram now. That's like, for whatever reason, I'm starting to get messages on Instagram all of a sudden, and I respond to every single message, and it doesn't matter if you're a seasoned investor or, you're just learning, I will answer questions. I'll share book recommendations. I send books to people all the time. So I just love to share my knowledge, and, it's been such a lifelong journey and an incredible journey for me that if I can share my passion with someone else and make a difference for someone else, it makes me really happy.
Awesome.
And I do that for people, whether they invest with me or not.
Eric, I'm grateful for your time today and just really talking through publicly traded real estate. It's just an interesting thought that, I don't know that we've ever talked about it on the show, maybe once or twice, but out of 900 plus shows, that's not too often. It's just grateful to, raise awareness, right, to our investors that are listening and operators, that this option is out there, and at least to go educate yourself or meet somebody like Eric so you can ask, more questions about this opportunity. But again, grateful for laying many things out that we need to know about this type of investing in real estate. Tell the listeners how they can get in touch with you and learn more about you.
Yeah. So, you can go onto my website. It's gscm.co. I also have a personal website, ericschleien.com. But then if they just want to, not contact me through the websites, I'm very, very active on Twitter. It's just, my handle's Eric Schleien. And the spelling, I would imagine you can just put in the show notes so they can click on it. And then I'm also very active on Instagram, and it's also Eric Schleien on Instagram. So I do respond to every message, and I love, participating in conversations with people.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.